Aditya Birla Sun Life Mutual Fund presents Voyage 2021, partnered by ET Now, is in its 8th year, and the flagship event aims to help investors and distributors understand the market volatility and how can one secure their financial future post the COVID-19 pandemic. On this episode, watch as Senior Fund Manager Fixed Income at Aditya Birla Sun Life AMC, Kaustubh Gupta, describes the fixed income outlook of the economy post the pandemic and whether 2021 will bring stabilization in the market momentum. Let's find out.
I would be sharing our take on likely impact of these measures on macroeconomic variables and our outlook on the fixed income. But before we start, let me just remind you that calendar year 2020 will not only be remembered as the year of COVID disruption, but also as the year when policymakers did unleash large coordinated fiscal, monetary and medical response to our crisis. Let me start with a brief global take. At the start of fiscal year 2021, when the COVID hit us, it seems that it will leave us with a large and widespread dent on the economy. Global GDP was expected to degrow by about 6 to 6.5%, and about 85% of the economy were expected to enter into recession. Thankfully, due to the learnings of 2008, policymakers were forced to act meaningfully and swiftly. As we speak, it seems recovery is on its way, and barring few geographies and few sectors largely linked to service economy, most of the things are into normalization phase. As the vaccination drive starts and is get entrenched into the economy, even these economies or geographies and these specific sectors are also expected to contribute to the growth normalization. Coming on to the next year, which is FY22, RBI projects that in FY22, Indian GDP will grow at about 10.5%, and most of the economists on the street, they are expecting the growth of about 10 to 12%. Our expectation is that in FY22, we will be growing at the rate of about 13% with some upside risk. This difference is on account of our assessment of COVID impact on the economy, pace of normalization of economic activity, lag impact of RBI easing, which they have done over the last 12 months, and series of steps that our government has taken to arrest the slowdown, most important, budget. Now, coming to one of the most important question of this session, which is that with a big growth and expectation from the RBI to start normalization path later on this year, is fixed income a space or a safer space for the investors or not? There is least doubt that the path of least resistance for the rate is to go higher. But our sense is that given the intent that RBI has shown in the last policy, that there will be any normalization path will be well telegraphed and it will be in calibrated manner. Clearly, big duration gains are behind us and there are forces on both sides to push and pull rates. Having said that, liquidity is in abundance and over next 12 months, we still think reverse repo will remain operative rate. Having said that, again, from the longer end perspectives, curves are in the curves on real yields, they are generally higher than what they used to be in a pre-pandemic period. Curves have clearly become steeper and there is adequate compensation for the associated walls that anyone want to invest.
He also answered the questions put to him by ET Now's Ajay Sharma.
Just wanted to understand from you on the growth front first, the way Indian growth actually did not really collapse. It did collapse, but the equally sharp was the rebound. What, to your mind, was the reason for the resilience of growth here in India, even in such a pandemic kind of a situation?
Okay, look, our assessment is that, first of all, the COVID impact on the real economy was a lot lesser and normalization path has been quite swifter. But more important, there is a little bit of an accounting path on this, because of which the growth has been the degrowth has been lesser than what was anticipated initially.
Kaustubh, we also see in the last few weeks, almost every company has been raising their prices, steel, cement, FMCG, all of them, as if, it's a return of inflation. And if it does happen, how does it really impact the fixed income investing environment?
One need to be watchful on these inflation numbers, but our sense is that still, as far as the growth normalization path is concerned, it is not that this will lead to a significant increase in inflationary expectations from here on.
And lastly, Kaustubh, as a house view, what would your advice be for investors who are looking 1 to 2 year far out for fixed income?
Look, of course, there are pulls and pushes on the both sides, but on the shorter end of the curve, there are mismatches. These, even for push and pull mismatches on the shorter end of the curve, are a lot more balanced because the supply on the shorter end of the curve is a lot more muted as compared to the longer end of the curve. Given that the liquidity is surplus and it is likely to remain in abundance for rest of the calendar year, given that the RBI has committed itself that they will move in a very calibrated manner, maybe more telegraphed manner, it seems market has gone too ahead on the normalization path while pricing these curves. So we clearly see that the shorter end of the curve, which is basically 1 to 2 year bonds and probably 3-year bonds, they are an opportunity for the fixed income investors, but not only as an accrual, but also some bit as a capital gains, which could come in over next 6 months.
Next up, we have two senior fund managers, fixed income from Aditya Birla Sun Life AMC, talking about the interest rate channel of transmission and whether the policies affect the availability and price of credit going forward. Let's listen in.
We're here to talk about what the fixed income as well as the credit market is going to look like in the year ahead. Sunena, if I could come to you, when it comes to the credit market, we've seen a lot of, jolts ever since the INFS crisis. Is it safe to assume, and would it even be a prudent sort of line of thinking to assume that the worst is behind us? Or would you say that the picture out, ahead of us is still very much hazy?
I think very much so the worst is behind us. In fact, over the last 6 or 7 months, we've seen a relative period of calm in the credit markets. You're right, last 2 years have been, fairly volatile post ILNFS default because it was followed by a series of defaults thereafter. And a lot of them, AAA rated names. There was the NBFC crisis, asset prices, went for toss. A lot of large groups went for a toss. And I think post the economic lockdown that we saw post the pandemic, that is when, I think we peaked in terms of the credit crisis in our country. Because post that, the combined actions taken by both RBI as well as by the FinMin has ensured that, there's ample liquidity available in the system. There have been targeted TLTROs. RBI has cut rates very dramatically and tried to ensure that there is, a liquidity available at low rates to companies.
Mohit, Sunena is convinced that after a very volatile last 2 years, the credit markets are in a good place. But tell me, what are high frequency indicators pointing towards? Are we in for a good go from here onwards, or would you think there could be some more stumbles to come?
So, slowly we have started seeing high frequency indicators, moving up. The PMI has been, 55, around 55 mark for last 4-5 months. The power consumption has started going up. The GST collections are printing all-time high numbers. The e-way bill 10% kind of, year on 10% kind of growth. So high frequency indicators have started showing the green shoots, and I think going forward we will see more and more of it, simply because the government has decided to go a slightly different path compared to what it had done in last 5-6 years. Just to give you a context, the fiscal deficit that the central government ran for last 5 years was around 3.5%. But the trajectory for next 5 years will average around 5.5%. So that's 2% of GDP extra, and that is only central government. Now, if central government does so much of infra investment, then it will crowd in the private investment as well. So both of it put together, it looks positive for the near as well as medium term.
So, Sunena, before we wind up, are the prospects looking bright for fixed income investments? Because all the viewers watching us right now would just have one question on their mind, whether or not they should increase allocation to fixed income.
As far as fixed income is concerned, I think the gains in duration are behind us. Ahead of us, we'll have a slight period of volatility, and investors should be opportunistic to take advantage of that and play that, a large amount of liquidity, steepness of the curve. And play that out.
I would say that this is against the normal thought, but I think at some point we'll start attracting FI money, external money as well, and banking and index inclusion would help. So that's a slightly contrasting view from the market.
That's quite an interesting view. But Sunena, Mohit, thank you so much for taking your time out and trying to break it down as to how the fixed income as well as credit market is going to shape up in the year ahead.
Welcome back to Aditya Birla Sun Life Mutual Fund presents Voyage 2021 partnered by ET Now. Up next, we have an interesting session by industry stalwarts talking about how the diversification in a portfolio spreads the risk across asset categories. Let's listen in.
We have a very great panel coming in. Mahesh Patil needs no introduction. Manish Dangi and Vinod Bhatt are also with us. So let's start the session. Manish, let me start with you first. The most important and the basic question. Why is asset allocation important if you're looking to invest for the long run, create wealth, and make your wealth compound over the long run?
Asset allocation as a principle has this idea that each individual has to figure out what he is in context of the risk return framework that each asset offers, and then a mix of that should mean that he ends up getting what he wants in terms of the life goals that he has. So it is the most important question, and perhaps if no other problem that you want to solve for the capital, you must solve the asset allocation problem.
Right. Manish, let me come to you. You would have faced this problem various periods of time. So, we've had the Lehman crisis, which we've seen, taper tantrum, probably IL&FS issue, COVID crisis. So in such a scenario, two questions. One is, if you have a correct asset allocation, how do things get better? And how should one change asset allocation when you see, such sort of movement happening into various asset classes?
My assessment of, asset allocation is a little macro in nature. I think, there are ways to deduce how exactly various assets would move in a certain macro context. They tend to rhyme. They tend to sort of, sometimes certain asset classes tend to get overheated. In certain other times, they get hammered far too much. So I think that, one strategy is to simply have a passive allocation, but for my personal allocation, I tend to use my macro framework to allocate primarily between fixed income and equity. So that's the way I look at asset allocation. Yes.
Right. So Mahesh, let's get your perspective. What did you do in taper tantrum? What did you do in COVID crisis? How were things when mid cap and small cap was going up? How did you essentially use asset allocation to protect returns and then to generate alpha?
Thank you, Pankaj. So as Manish mentioned, that's a classical framework, which we use in terms of looking across various asset classes, looking at the macro picture, and then looking at which cycle an asset class is, right? And then deciding, how much to allocate to it. But to put it in a very simplistic manner, right, for investors, who are trying to do their own asset allocation, I would say, see, each asset class has a certain long-term return, right? If you look at long-term return of asset, like for equities, for example, it will be somewhere around, if you look at a last 20-year return or 25-year return, it will be around 12 to 13% in that range, right? Gold would be somewhere around 9 to 10%. Real estate would be around 8 to 9%. Again, this is only looking at the top metros because real estate is a more micro market and the returns could vary depending on the micro markets. Again, bonds and this thing would be around 7.5% or so. And what happens is that each asset class goes through various cycles. I mean, there are periods, where a particular asset class can give significantly higher returns than its long-term potential. And there are periods where it can be significantly lower. And over a period of time, the returns tend to converge or mean reward. So by that logic, whenever an asset class goes through an extended period of downturn or a pain or below its potential long-term returns, I think that's the time to really seriously start looking and evaluating and taking a call whether one needs to increase allocation towards that asset class. And if you follow that principle, kind of a contrarian approach, and stick to the philosophy that the long-term returns tend to mean reward, I think that can do well to the overall portfolio from a longer-term perspective. But I mean, that's a very, very simplistic way of putting at it. So whenever there is a crisis, I would say that, I mean, that's the time when the allocation towards that asset class in your portfolio would have gone down, right? Because of the price movement in that asset class. And one way is to look at that passively, you would want to increase the allocation in line with your target allocation. But I would suggest that that's the time when one should be slightly more aggressive
For most of the people, asset allocation may only be a debt income or a FD and probably investing into mutual funds via equities. But it's much beyond that. Can you talk more about that? What are the other asset classes that one should consider? Should gold, a little bit of cash, various other things should be a very important part of the portfolio?
Yeah, thanks, Pankaj. As you correctly mentioned in the beginning, the right way to think about asset allocation is like, we have a balanced meal, right? So for example, if I want to eat healthy food and I just eat salad all the time, it's not going to help, right? And if I just eat junk food and dessert all the time, that's not going to help either, right? So what I want to do is have a balanced meal with my roti, sabzi, dal, rice, and so on. And asset allocation works in the same way, right? So we find in India a lot of investors maybe have like overexposure to real estate or to gold, right? And that doesn't work in the long term. So the right way to think about it is, if you look at the four major asset classes, right? It's equities, fixed income, gold, and real estate, right? Now, as Manish and Mahesh correctly mentioned, equities are the compounding machine, where if you have time on your side, you can use that to create wealth, right? Uh, Fixed income is like your, a defender in a football team, right? It gives balance to the portfolio. Gold is like the goalkeeper in a football team. It provides a hedge against volatility, right? And real estate, of course, is an asset you can have for the long term. So this is how investors should think about having a balanced portfolio. They should not go overweight on one or the other. And of course, they have to do a periodic rebalancing. But they need to have all these components in the portfolio. And especially in the current times, there are a lot of other assets one can look at, although not in India right now. So for example, as we all know, in the US, for example, Bitcoin is being looked at as an alternative to gold. It's called a digital gold, right? So maybe going forward, we will have more alternatives to look at, and we should always be open to these new ideas.
So, Vinod, say if somebody is watching this, somebody is an active mutual fund investor, looks at SIPs, looks at changes within the schemes of various funds, and has not been following asset allocation. What should he do right away? What should be the basic steps before he starts to take those steps? Any advice for such people who have been active in mutual funds across products but have not been probably following asset allocation?
Yeah, so in my experience, I've been managing the ABSL Asset Allocator Fund of Fund for the past year and a half now, and I understand how difficult it would be for an individual investor to track the markets and make the right changes in the portfolio. So I would definitely suggest that rather than individual investors trying to do asset allocation and periodic rebalancing on their own, I would recommend that they consider a product like the Aditya Birla Sun Life Asset Allocator Fund of Funds, and I'll explain why. Because if you look at the process I follow, I'll just walk you through it. It's not that straightforward, right? So the best way to think about it is to think like you're the selector of the Indian cricket team or a football team, right? So you don't just select all batsmen or bowlers in a cricket team, and you don't just select all forwards in a football team, right? You want to have the right balance, and that's why in our Asset Allocator Fund of Fund, we have domestic equity, international equity, fixed income, and gold, right? That's the starting point.
Vinod, you mentioned about various asset classes, when we spoke earlier. And when we just spoke to, Manish, he pointed out that equities, probably the domestic ones, and the global equities as well are an important part. How important is global equities, or it's important to get it like, India right, India bonds right, and then probably, commodities and some of the other assets that you mentioned earlier?
Yeah, definitely. I think it's always better to think of a core satellite approach. And for an Indian investor, there's a lot of opportunity in India, right? So domestic equities and local fixed income will form the core part of the portfolio. And international equity will be on a tactical basis, right? That's part of the satellite portfolio. So even in our asset allocator fund, currently, we have about 66% allocated to equity, and out of that, about 6% is to international equities, right? So that's how we are playing it. So 10% of our equity allocation is to the international equity, and that's how we think about it.
Right. Thank you so much, and hope our viewers learned a lot. I did, and hope people follow asset allocation or try to follow asset allocation with the various techniques that you just said.
That brings us to the close of another trend-setting edition of Aditya Birla Sun Life Mutual Fund presents Voyage 2021, partnered by ET Now, which saw leaders from different walks of life share their vision for the new decade. Thank you for watching.